This is why trading the news is a trap. Every time there's a big economic announcement, you see the same thing all over social media. CPI beat expectations, FOMC was dovish, rate cuts are coming, and immediately traders rush to their charts trying to trade the news. But here is one uncomfortable truth. News doesn't move markets, positioning does. And if you trade the news the way most retail traders do, you're not early, you're not smart, you're just liquidity. Today, I want to show you why trading the news is one of the biggest traps in trading and how professionals actually use news events very differently. Let's start with the biggest misconception in trading. Most traders believe this simple idea. Good news means price goes up. Bad news means price goes down. That sounds logical, right? But markets don't work on logic, they work on incentives. By the time you read the headline, by the time the news alert hits your phone, or by the time X starts reacting, the market is already positioned. Institutions don't wait for the announcement. They position days or weeks in advance, so when retail traders buy because of good news, they're not joining the move. They're often exiting it for someone else. This is why you see it all the time. Good news, price drops. Bad news, price rallies. Not because the news was wrong, but because the positioning was already one-sided. Now let's talk about why retail traders consistently lose money around news events. There are three main reasons. First, timing disadvantage. Retail reacts, institutions anticipate. By the time you click buy or sell, the smart money is already managing exits, hedging, or fading emotions. And second, you have an execution disadvantage. Spreads widen, slippage increases, stops get skipped. Even if you're right on direction, your execution is worse at the exact moment you need it to be perfect. And third, this is the most important, emotional distortion. News creates urgency. Urgency kills discipline. When a candle explodes during news, your brain doesn't think in probabilities anymore. It thinks in fear and excitement. And that's exactly when markets punish mistakes the hardest. News doesn't create opportunities for retail traders. It exposes weaknesses. Now, here's the part most YouTube videos never explain. Professional traders don't trade the headline. They trade the reaction. Instead of asking, was the news good or bad, they ask, how did price react and why? The first question professionals ask themselves, was the reaction strong or weak? If the news is extremely bullish, but price barely moves, that's not strength, it's absorption. It means someone was selling into enthusiasm. If the news is bad, but price recovers quickly, that's not confusion. That's strength hiding beneath fear. The second question professionals ask themselves, did price continue or reject? Continuation tells you positioning was aligned. Rejection tells you expectations were wrong. News events are not signals, they are stress tests for existing positions. And here's professional question 3. Where did liquidity get taken? News often acts as a liquidity magnet. Obvious highs get swept and obvious lows get flushed. Not because the market reacted to news, but because news creates the perfect execution to trigger stops and rebalance positions. Okay, here's a very nice example for you guys. We're on the Bitcoin 5-minute chart right now, and we are 5 minutes before FOMC. So the next candle that will come here will be the FOMC candle, and it will probably come in with high volatility. But first, we want to have a look at the situation right before FOMC. And here we have this low, and we have this high. And traders who think, oh, I know there will be bad news, so I'm short, I will go short and I will benefit on this down move, and I'm expecting something like this. And the other side, the traders with a stop loss below this low, they're thinking, oh, I know price will go up, there will be good news, and that's why I'm 100x long, because I'm expecting something like this. And what do you think, guys? Do you think this will happen? Let's see what the FOMC candle brings. Here it comes. Oh, that's really sad. All the traders with their stop losses above this high got stopped out first, and afterwards all the traders with a stop loss below this low got stopped out as well on this candle. They both got scammed by the market. Please guys, don't be one of these traders. Don't be one of these traders. Just stay away from trading news events. It never works. Maybe 1 out of 100 times, and that's not enough. So this is a perfect example of what happens nearly all the time. So please stay away from news trading. Let me give you a clean, practical framework you can actually use, not to trade the news, but to avoid being trapped by it. Here's step 1. Define the context before the news. Ask one simple question. Is the market trending, ranging, or compressing? If price is already extended into the announcement, expect volatility, not continuation. And here comes step 2. Do nothing during the announcement. Really, nothing. Yes, nothing. No guessing, no predicting, no gambling. Let the market show its hands first. And here comes step 3. Observe the reaction, not the candle itself. Don't focus on how big the candle is. Focus on, does price hold gains? Does it retrace aggressively? Or does volatility expand or collapse? And here's step 4. Only trade after structure returns. Professional traders wait for structure to reform. They let volatility cool down. They let emotions burn out. Only then they execute with confirmation and not hope. So here's another very nice example for you guys. This time we're on the NQ 5-minute chart. And this is the CPI candle. Very interesting. And what we want to have a look at is what happened before this news event. And as you can see, we started with a nice uptrend, forming higher highs, higher lows, and then the CPI came. And what happened? We grabbed all the liquidity above the highs right here. All the people who went short and thought, I can participate on this news event, got stopped out. And then we flushed all the lows here below this low as well. All the people who were long got flushed out as well. And now it gets interesting to see what happens after the news event, because we started a recovery with some green bars, then printed a first little low, and then a higher high here, and then a higher low above this low. So what we can see that this is another uptrend, right? And it probably will continue. And it's the continuation of the uptrend we had before. So the news event was just a break in between to flush out all the shorts and all the longs. And then the direction we had before the event continues. And here is the point where you start looking for long entries again. This is where most traders misuse indicators during news. They expect indicators to predict the move. That's backwards. Indicators are execution tools, not decision makers. After news, tools are useful for just one thing: confirmation that the market has stabilized enough to trade again. If you use indicators to chase news volatility, you're asking them to do a job they were never designed for. Let me get back to the previous example on the NQ 5-minute chart, where we had the CPI candle and we had this uptrend right here. And then we started to print a higher high and a lower high. So we see that the uptrend from before continues. And what we do now is we can start looking for long signals. In this case, I'm using the Trend Bars Pro indicator by TRN Trading, as it prints strong reversal signals. And in this case, we have a bullish reversal bar right after we formed the higher low after the news candle. And this could be a nice entry in this case. And this would be a very nice long entry in this case. But we always want to see how price behaves after the news event. The uptrend continue with a higher high and then a higher low. And this is why this is a valid signal. So we could enter a long trade right at candle close, stop loss below the low, and then a risk reward ratio of 2. This always works fine if you trade these candles. A risk reward ratio of 2 is the right decision. So let's see if the uptrend continues, and it does. We had a nice uptrend, new higher highs, higher lows. You can see the whole uptrend we started here, yeah, with higher lows and higher highs, continued right after the news event, right? Sometimes it even can be helpful if you imagine that this candle wouldn't be even there, honestly. It's just like this trend would have continued without this news event. And for sure, it works the same way in downtrends. This is just one example. So let me leave you with this. News is not an opportunity. News is a test of patience, a test of discipline, and a test of whether you trade structure or emotion. Retail traders try to predict the headline. Professionals wait for the reaction. And the biggest edge you can develop is knowing when not to trade. If this changed the way you look at news and trading, make sure to subscribe. More videos like this coming, focused on how markets actually work, not how social media wants you to believe they work.